It's been a minute since I made one of these videos, but I really wanted to talk about this, so I figured I'd do it. Uh, as usual, I'll talk about what the video is about first, so I don't waste your time. If you don't want to listen, you don't have to. So this video is going to be about Bed Bath & Beyond and the overall short squeeze that's happening in the market right now. And yeah, I want to get a little bit more deeper into this and explain what's really going on. I think it's, pretty good information. And I've been busy not posting because some housekeeping stuff. I've been really working on the site, guys. So hopefully it's up by next week, and it's going to have the options course on it and the real estate analysis course on it. So hopefully that will be done here shortly. All right, so let's just get into this thing. So as you can see, I posted about it last Friday that the Wall Street bettors down there were like, hey, this is going to blow up. And, essentially not only was the stock short, but it was short, once again, 20% above the outstanding shares, right? So if there was like 100 million shares, there was 120 million shares short. And I'm just going to take it over, or explain this, like if you didn't know what short selling was, and if you don't, know anything, and, if you watch this video, then you'll have a decent understanding. And I'm going to try to do the best job I can. I got an article pulled up, and we'll go through it together. So, short selling in a sense is just like, here, I'm getting fancy now, guys. Look at this. Got a little drawing board, right? All right. So like Bill Ackman did it the best. I posted a video about it like a couple years ago. I couldn't find it. I'm too lazy to look through it. So I'll just explain it again. So let's say your buddy has like some quarters and like rare quarters, right? Like it's, 25 cents, whatever, a quarter. And this quarter is worth like, like $50, right now. But that, you think the value of this quarter is going to go down, right? And the same thing, replace the quarter with the stock, same difference. So what you tell your buddy is like, yo, let me borrow that quarter, right? So this is you, you're in the middle. Yeah, shit, I really suck at this, so bear with me. That's you in the middle. And then you have a buyer here lined up. This is cool. My first time using this shit. Bear with me. Yeah, there we go. It works. Okay. So somebody here has a quarter. The quarter's worth $50. You're in the middle. You say, hey, let me borrow this quarter from you. And you're gonna pay him interest. You're gonna pay him some interest. You pay him like $1, right? And it could be down to a time like, let me borrow it for 3 months, 6 months, a year, and you'll pay the equivalent interest, right? So this is what short sellers are doing with stocks, right? So what you do is you get the quarter and you immediately sell it to somebody else in the market. Okay, so now you have $50, in your pocket, right? Because it's still worth $50 today. The second that you borrow it is the same time that you sell it. But then let's say some time goes on and let's say it's like 2 months later. I'm not gonna draw too much, but 2 months later, the quarter is now worth like freaking $30, right? And you're like, nice, okay, let's buy this back. So what do? You go back to the original guy, and it's stock market. It doesn't really matter. You go to like millions of people that have done this, right? And you buy it back for 30, and you give it back to your buddy. Well, your buddy doesn't really care because he was going to keep the quarter no matter what. But you just made $20, right? Minus the dollar, or minus the dollar from minus the dollar in interest you paid, you made $19, right? Because the quarter from this profit was 20 minus $1, you made $19. Yay, good for you. You're happy. That's usually how short selling works. Is you have someone that owns stock is sitting in a brokerage, is sitting in wherever, and the broker lends it out, and you immediately sell it, and you're hoping the stock goes down. And then if the stock goes down, you buy it back and you give back the shares and you keep the money because you keep this original cash in your pocket. And it only works if it's here. It doesn't work if all of a sudden the quarter's worth $70 because they say, I don't know, like all the other quarters in the world are lost and this goes to $70. Well, now you're out money, right? Now you're out negative $21, right? That's how essentially it works. And these guys have been doing this for a long freaking time, bro. Like, I just pulled up a couple of tweets. Like, look at this. This was freaking Jim Cramer on August 10th. And let's see if this thing will pull up right here. And I keep hearing, oh, Jesus. There we go. let's see. All right, I keep hearing that Bed Bath is the next JC Penney, and it makes a lot of sense, especially with same store sales down an astonishing 27%. Almost nobody comes back from that. Nobody. Yeah, boy, was that guy wrong, right? Like what happened today. And we'll get into this other tweet later. And this is just something I want to say about Bed Bath & Beyond. The fundamentals of the company were amazing. The problem is they've been getting screwed over by companies like Amazon. And this is where, I think Bed Bath & Beyond, I don't know if they had a lawsuit or they should, because I listened to a podcast called The Investors Podcast. It's a really good podcast. And they were talking about this stock like pre-pandemic. This is like 2018, right? And essentially, the problem they're having is like, let's say Bed Bath & Beyond has like a carpet for sale for like $20 or like whatever, right? Amazon was undercutting, and Amazon was actually selling at a loss to try to like drive them out. Obviously, Amazon can rely on other aspects of their business, such as cloud and, selling other things for profit, that they could essentially kill them. And that's not fair, right? So they have been getting a short end of the stick. But I will say another thing. Bed Bath & Beyond has bought back a lot of their own company stock. They were actually profitable, as a company. It's not like they were, just absolutely sucky, but, at the end of it, what happened is guys like Jim Cramer and his cronies there started, pumping that BS, right? And if you actually look at, like, let's see, BBBY stock, if you look at this, let's say like a month ago, you're down in the dumps here. It was like $4, $5, right? And so what happened is these guys are doing this shorting stuff. Basically, they're, bringing the stock down. They're going to make a shit ton of money. And to them, what they really wanted to do was make the company go to freaking zero. Because if you could get the company to go to absolutely zero, what happens? Whatever stock you sold at $5, you sold it off to some sucker, right, on the open market at $5. And you're going to keep like almost 100, I don't know, that's a crazy multiple percent of the stock. Because when it goes bankrupt, you'll buy it back for like less than a penny. Or you're not even going to own it because no one's even going to want it. Your shit gets settled out and you walk away with a big ass bag. And these guys have been doing this for decades now. Now it has finally caught up to them. And for some reason, after everything that happened with AMC, everything that happened with GameStop, you'd think that they would realize, oh shit, this isn't working. People are actually catching on. We shouldn't do this. Let's find other ways to make money. No, they still try to do it. And, now they got caught with their pants down. And I don't know how much higher it's going to go. I don't know if this is the absolute top or if it's going to go lower. I mean, it was up a lot higher, this today. Now it's down a little bit. But what the crazy part is it's one thing if you're just shorting the stock, right? Like that's not a big, look, I don't think it should be illegal to short a stock. There's a bunch of reasons you want to short a stock. Like you could, in a way even protect your portfolio, because it doesn't always mean to borrow shares. You can short a stock by just like buying a put, right? Like just thinking the stock's going to go down. So if you actually were a long-term, shareholder in a company and you buy a few puts because you're scared, market environment, yada, it's not a bad thing. And it is healthy that, you have people that are willing to short because it creates liquidity and, real businesses stay and, usually fake businesses fall. But that's just not the world we look in. But that's not how it's being used. It's being used by these hedge funds to absolutely destroy companies and destroy investors. And, now they're getting a taste of their own medicine. So this is what's really, really interesting here is the use of synthetic stocks. And if you bear with me, we'll read through this and I'll try to do my best to explain it in layman's terms. So then, you could explain what's been going on. And this is exactly what happened to AMC. This is exactly what happened with GameStop is, usually in this example, there's only so many quarters in the world, right? Like there's like, let's say 10,000, 10,000 of these quarters, right? So if you're shorting it, you shouldn't be able to short more than 10,000. Well, using synthetic shares, you could short, let's say if this quarter was going to be absolutely worthless because you knew somehow that America or whatever quarter this was, they were going to reprint this same exact quarter. And therefore it wasn't going to be worth $50 anymore. It was actually going to be worth exactly 25 cents, right? If you knew that information, Imagine if you could sell this quarter like, 15,000 of these quarters, right? And you're like, how's that possible? There's only 10,000. So how could you sell 15,000? Well, that's where the synthetic side of things come in. And that's really what's happened. And we kind of knew that this type of setup was crazy because the company bought back so many shares, right? There's already so many shares with long-term holders, right? So when you're shorting something, you usually have to short on whatever like the float is. So if there's like 100 million shares, 90 million shares are held by guys that are like absolutely locked in, like this is their company. They're not selling it. You should only be able to short really 10 million because that's all that should be available. Well, the truth is the way this whole system is set up, nobody really has an actual real accounting of how many shares are actually out there, right? Like this goes through clearinghouses and all this other crap, and it's like all confusing and nobody ever really knows. We have to rely on third-party information to really see, hey, like through these filings, like, hey, wait a minute, this company is short, 10 million shares. That company's short 10 million shares. That company's short 10 million. Wait a minute. There's 50 million shares short. Hold up. There's only 100 million shares in the company, and 90 million of those shares are owned by the CEO and all these pension funds. So how is this company short 50 million shares when they should only be able to short 10? Let me look into this. And then you realize, oh shit, they're going to have to cover, right? Because what happens here? If somebody else, when you sell this right away and somebody else comes up and buys it for 50 and another person buys it for 60, and then this guy says, oh my God, that quarter has gone up to, $70 now. Hey, I want you to give me back excuse me. I want you to give me back my quarter. Well, now you're going to have to go out to the market and buy it at that market price. So that just causes the price to even go up and up and up. And that's essentially what a short squeeze is, right? And let's go back to the synthetic shares, because this is what makes it crazy, is the fact that you're able to sell more than what you should really be allowed to sell, because there's only should be a certain amount of shares available for you to sell short. So this also covers another strategy, not just for shorting, but also for like hedging yourself. So we'll start off at the top. So a synthetic stock is an asset created from a combination of other forms of assets. A synthetic stock position is a derivative trade designed to simulate cash or spot position. So it's basically, once you put this trade on, it acts like a real share, or it acts like money. The equity options market is typically used to create a synthetic stock option. The most common form, which is constructed using common exchanges, trade options, long and short synthetic stock positions can be created using a various combination of puts and calls. These positions duplicate the profit and loss scenarios of the stock ownership. So it goes down to saying, we'll skip over this. So it basically comes down to saying, like, you want to sell. Basically, these guys, they sell a naked call, and then they buy a put at the same time to simulate having a stock, right? So what happens is, and if you read the rest of this article, you can find it at smartcapital.com/in-investing in what-is synthetic stocks, right? So short synthetic positions are created by buying a put and selling a call. The same rules apply to the expiration date and the strike price. The delta of 50, which means they're always at the money, they're even. So essentially, a hedge fund, back when Bed Bath & Beyond was at $5, to make more money, what they're going to do is they're going to sell the $5 call option and they're going to buy the $5 put option all at the same time. So that in the eyes of a broker like TD Ameritrade or whoever they're brokering with, indicates that they have a stock, they have a share, right? And they're able to sell that even short. But the thing is, both those positions are open, right? So when they sold that $5 call, they're on the hook. They owe somebody Bed Bath & Beyond shares at $5. And when they bought that $5 put, someone else has to buy Bed Bath & Beyond at $5. So their idea is, hey, this shit's going to zero, baby. We're going to sell that $5 call. We're going to get all of that $5 because this company's going to zero. And we're going to double dip because that put is also going to bring the company to zero. So we're going to keep all that $5, right? Because they used the money that they made from selling the $5 call, that premium, to pay for the put. So essentially, they're making $10 per share if the stock goes under. Well, these synthetic shares, they were short 20, I think like 10 or $20 million or 10 or 20 million shares above what the float is. So there was only 100 million shares, and these guys had a negative 20 million short, right? So what happened is that 20 million that they're on the hook for, when this stock went to $20, they now have to either close that option position out by buying an option at a higher strike price, or they have to close it out by paying that money, $5 minus 20, that extra $15, they're losing that out of their pocket. And that's what happens. And that's just to cover the synthetic side, right? That's just to put money into, oh my God, close out the synthetic shares that we have. And only God knows how many synthetic shares they really have, right? Because we don't have access to that information right away. You know what I mean? And we don't know how much is on their books because we have to wait for their filings, right? And so that's the synthetic side. Then you actually have the actual shares that they actually have to buy back. And that's where it gets like, that's where the real squeeze comes in. So not only are they going to have to close and buy these options at whatever price to close them out, or pay it off and just close the position out and pay out whoever they sold that option to, they're paying them that. Just be like, hey man, I'm done. Close me out, tap me out. Now, if they're short those shares, they're going to have to buy those shares back at this $20 price. And in the real world, unlike our little fake scenario that we drew up here, when the stock price goes this high, the guy that let you borrow that share, or in this case, the greedy freaking hedge funds, that interest is no longer going to be $1. It's like, yo, Buck, hey, bud, it was $1 when the stock was at $5. Now that it's at $20, hey, I'm going to charge $4 interest, right? So now the hedge funds, they're just getting squeezed out because they're like, shit, the interest is hella high. Shit, I lost hella money because the stock went up. And that's essentially what that squeeze is all about. And it's going to be interesting to see, how this all shakes out. And because of this, everything else started rallying up too, right? Like GameStop went up, Be Big, shout out, went up. It was up almost 70% today. Be Big was, and but I'm not sure about the other stocks. I haven't looked into how short they are or whatever. But when you see a play like this that's just set up, it's just like, bro, like eventually hedge funds are going to have to learn, we can't do this. Now, on the flip side of this, they could be really sneaky. And, I guess what you could do is they could be selling short, putting this data out. And then what they could do is end up buying a long position or, buying long calls, way out of the money just to protect themselves. That's what they should be doing. That is exactly how you should be doing. But sometimes we've noticed these guys are so greedy and so arrogant that they don't even buy that. And what I mean by that is, if you sell a $5 call naked, right, you're telling somebody, I will give you 100 shares of Bed Bath & Beyond at $5 on this date and time. And then you're going to have the cash to back it up, right? And you have to have a lot of cash. But normal people wouldn't do that risk. They'd be like, oh my God, what if this thing goes to $20, $30, right? So what normal people would do is if you sell a $5 call, usually you either have 100 shares in your account, right? That's a covered call. Or what you do is okay, I'm going to sell this $5 call because the premium's really high. But to protect myself, I'm going to buy a call at a higher strike. I'll buy it at $10, right? Now you're willing to, mitigate your risk. The only money you can lose is from 5 to 10. But these guys are out for blood. They don't hedge themselves. They're like, screw that, screw hedging. We're going raw dog in this thing, right? They'll sell that $5 call, no hedge, and they'll buy a $5 put, and they're hoping that the stock just absolutely dies and they bleed it out. And when it does it and it goes up 316%, now they have to pay that higher price. They're going to have to pay $15 pretty much, out of pocket, right? And like I said, I thought hedge funds would learn from this, so I'll wrap it up with this. But this time around, Citadel, who was all around the whole GameStop fiasco, and because they're tied in with Robinhood, and we all know how that all ended up. In their 13F filings, they took I don't know if that's shares, but they took a 2 million. I'm pretty sure it's shares. They took a 2 million share position on Bed Bath & Beyond. So it'll be interesting. I don't know if they are. Oh no, this is probably dollars. Yeah, this is probably dollars, not shares. But if they're shorting this or not, if they are, and that's they're getting smarter. But by actually buying the shares and then hedging themselves by then shorting it down. But I don't think they would do that. I think these guys started to realize, like, hey, last time we hosted the party. Screw that. You know, and our house got ruined and trashed. This time we're going to the party. And if they did, you know, what's going to happen is Bed Bath & Beyond is quickly probably going to escalate down, because if these are all shares, think about this, guys, like BlackRock, you know, Vanguard, these guys will probably hold, but, you know, Freeman Capital, Citadel, and, you know, some of these other smaller firms, I mean, they're up so much on the position, you best believe that they're gonna sell out. And what's crazy to me is they put this position on only about, so June 30th, so that's 31 plus whatever date we're in today in August. I think it's what, the 10th. It was only like 40 days, or no, it's August 16th. Like still 45, 46, 47 days, and they literally, you know, pretty much, Jesus, like almost 10x probably, or no, not 10x, 4x their holdings here. So interesting times. We'll see how this shakes out. But next time, you know, whenever you'll see this data come out, and I don't think that this type of investing is going away anytime soon until hedge funds really realize, okay, we can't get away with this shit anymore, and at the very least, we shouldn't be creating, you know, synthetic shares. We should just be trying to short what's available. Will that happen? I don't know. We'll see. So if you didn't know, you know, what synthetic shares were or what shorting was, I hope this video helped. Once again, look out for the site that'll be up soon for the free courses, and also be a way to support me in my work here if you guys enjoy what I do. So anyways, thanks for watching, and if you like this video or the content, you know, like it, you know, share it with a friend or family member. It'll help me out. Thanks, guys.